Oh, thanks, Joey, and thanks everyone for attending this call. So, I recently launched this book, Capital in the Shadows, and this is the context of this book was more to do with what professionals and students would require from understanding the private equity context, the investment context, not just from an academic perspective, but also from a real life implementation perspective. So, from the outside, then people think that private equity is about buying and selling companies, buy cheap, sell at a higher valuation, and make money out of it. And it's in the private market, so you have opportunity to design and leverage transactions as per your requirements. But that's not the only thing that makes private equity and an interesting career option as well as an interesting way to build and run companies. So it's about taking responsibility for them. It's about making sure that they grow in the right direction. And moving forward, you have a large platform play which can actually impact the way business is done in a particular sector to also change the world in its grandest outcome, right? So it's a sector of impact. And I remember while I was in IIM Indore, people typically wanted to take up, let's say, consulting as a career opportunity, or investment was not so much in the spotlight, and for various reasons. So there were not many private equity firms that existed in India back then. You didn't have campus hiring at a scale that you could see in other sectors, and you also didn't have the kind of education and knowledge base present in campuses for them to scale up rapidly when it comes to the domain and as such. So my attempt here, the Wisdom Talk series might be one such of a series of outcomes that we plan to do over the next 1 or 2 years. So the attempt here is to build a talent pipeline, build a base in institutes of repute where we can go tap into students, not just for the private equity ecosystem, but for allied ecosystems as well, and develop this as a overall theme emerging in India. So I'll just start with what private equity is. And just before I start off the presentation, probably I can time this well. So we have about an hour. So I'll take the first 45 minutes covering the presentation, and the remaining 20 minutes we can spend on Q&A. Hope that works for all. Private equity, it's a very different kind of a sector compared to others that you might have seen. You have investment banks which help in catering deals, which help in connecting buyers to sellers. You have the sellers who are typically companies, typically corporates who own subsidiaries, or even other private equity or investment firms that are running these companies. And you have the buyers who are, in this case, the private equity funds who want to purchase a company at a particular valuation, make sure that they perform well and exit. So a fund is built with a very specific objective. It raises money from a set of investors, and I'll get to how it raises money and how it's deployed. So raising money is the first part. Investing that money by sourcing deals, by making sure that where the money is being put in is the right outcome for the investors as a whole. Creating value, and then exiting over a period of 5 to 7 years. So that's typically the private equity life cycle from fundraising to exit. And if all goes well, you make a return which is beating what the investors expect, and you get a share in that return. And that's what makes the industry lucrative. So moving forward, I think there is a lot of competition in this space in India, and especially when it comes to both domestic and international capital. And therefore, fundraising is a challenging task in itself. You need to convince your investors that you're the right fund for the particular outcomes that they're looking at. You need to also source and evaluate investment opportunities. So that kind of forms the moat of the private equity ecosystem, to have people who have the capabilities and the sourcing networks to get the right kind of relationships and connects to find the right kind of companies to invest in, evaluating them in depth, and creating value where finding the gaps, typically what a consulting firm does for their clients like a BCG or a Bain or a McKinsey, finding the gaps, optimizing supply chains, optimizing inventories, and making sure there is value creation over the 5 year journey that I mentioned about dollar to exit them in that time cycle. So this is the broad cycle. And moving forward, I'll cover each one of these steps and how it ties up into the overall India journey. So as I mentioned, the private equity engine consists of investors who are in the slide mentioned as LPs, limited partners. The private equity fund itself is a GP, a general partner who invests some amount of capital, charge fees typically ranging to around 2% per annum for private equity funds, around 1.5% per annum for special situations, and even distressed funds. And you have a carried interest component, so you share around 20% of the profits that are generated and distributed amongst the team and the partners. So that's typically how the ecosystem works within the private equity fund. The limited partners are typically sovereign wealth funds, basically managing the wealth of entire countries. So you have Norges Bank of Norway, largest sovereign wealth fund in the world. You have GIC and Temasek in Singapore. You have the National Infrastructure Investment Fund in India, which is also a sovereign wealth fund, and pension funds, which manage pension capital, typically out of North America and Europe and other developed world geographies, where governments and corporates have an obligation to pay pension to their employees after a age of 60 to 65 to 67 years. And these funds typically invest in private equity funds to make sure that they are in a position to pay that pensions. And the private equity funds, as this diagram shows, invest in portfolio companies, and portfolio companies are the ones which drive returns for the fund as a whole. So if you look at the first step of this whole process, right, it is raising the fund in itself. And raising the fund, it's no mean task by any standard. So it usually involves a lot of relationship building. This is where the talent that you develop in an investment banking ecosystem or a consulting ecosystem is of some use. And you also have the opportunity to deal with funds and top managers at these investment and pension funds throughout the world. And that is a different experience altogether. And it's something that most professionals aspire to do, at least in the mid stage of their career, where you get exposure to large fundraising opportunities and moving forward can use those relationships to leverage the ecosystem and build a fund of their own. So that's typically how the journey goes in from a career standpoint in private equity. The investment period lasts anywhere between 0 to 4 years. That's when you scout for companies, make sure the evaluation process is very rigorous, and you have the approvals in place to make the right investments in the right companies, and have the right clauses in place where you can extract the right amount of value from these companies. And once the investment is done, there's a value creation period where there's no further capital that is available in the fund to deploy. So that's where you operationally optimize the companies for an IPO or selling it to another investor over a period of 5 years, and make sure that the inefficiencies in any company is resolved, and there is nothing that potential investors might foresee as a red flag or a corporate governance risk, which might impede their ability to invest in this portfolio company of us. So that would be the value creation period. Once you create value, you would always want to exit, as I mentioned in the prior slide. You find buyers for the company, you find IPO opportunities where you list it on the public markets. And at the end of 7, 8 years, you start harvesting some of your earlier investments, making money out of them. And that's where you also remit money to your investors and get the share of the profit pool. And that's the entire fund journey. If you do right in the fund one, raising funds for the next next one or two funds would become an easy process. If there's no performance in fund one, then raising subsequent funds is always always going to be a challenge. So that's the most important part of the fundraising process. And if you see as India as a geography, you have several large pension funds now entering into India. You have the Canadian pension funds, the likes of CDPQ and CPPIB, also doing direct investment. So that way, the pool of LP capital is now getting limited, while the pool of potential fund managers is increasing with newer opportunities and newer professionals entering into the market. So, having a quality team and a quality thesis and to back with a great track record becomes quintessential for raising capital. So that's about the fundraising process. Discipline and corporate governance are hygiene factors that cannot be tampered with and has to be top notch to make sure that the fundraise is successful. Family offices are up and coming for looking at opportunities such as these where they invest in other funds, and the opportunities are expanding in the Indian context right now. Now, once you raise funds, the next thing that any private equity fund would look at doing is getting into business. So this is what I mean. If you see the right or the left, sorry, is the deal funnel. So typically, it's not that you look at one deal and you end up investing in that deal. You have to source a lot of opportunities, and probably one or two amongst those 100 or 150 odd opportunities that we source do end up getting executed, where we as a fund invest in those opportunities. So the opportunity scouting is very selective. It's either thesis driven, it's either top down, where you build a thesis, you see what are the kind of areas or sectors that interest our investors, our fund mandate, and are in the right direction when it comes to growth and margin expansion within the geographical context, and make a call on which sectors do we follow. The other way is to also source relationships, either through intermediaries. This is where the banks, the global banks and the domestic banks, such as an ICICI or Goldman Sachs or Morgan Stanley, come into picture, where they pitch deals, build relationships with the private equity funds such as ourselves, and corporate clients and by other private equity funds who want to sell their companies on the other end, and try to make the market. So they connect the buyers to the sellers. The third opportunities, again, bottoms up, where the professionals themselves, the private equity team themselves could build these founder and corporate relationships over a period of time. And whenever there is a deal in those companies, you get first and exclusive access to those deals. So that's quite a differentiator, because you're not competing with other funds for the same deals, and therefore you will not overpay. And if there are no deals, there is also an opportunity to innovate and try to conceptualize deals on an ongoing basis, where it becomes more proprietary. And that's the differentiating factor that makes any private equity fund claim victory against their competitors and peers. So as I pointed out, for every 100 opportunities that are sourced, probably there's a one opportunity that a fund ends up investing in. There's a rigorous process of screening, where a lot of companies are shot down just because they don't fit the bill when it comes to mandate. There is a intense due diligence by the private equity teams themselves, from anyone from an analyst associate to a senior associate, VP, and a principal get involved to screen and diligence the deals, so that the financial metrics are proper, the business model is up to mark, and therefore there is opportunity to make money on the deal. Then there is a thorough diligence when it comes to the legal standing. Are there any legal issues? Are there any financial issues? Or are there any commercial issues in any deal? Or even tax and regulatory issues for that matter? Quite a number of deals get dropped at that point if there are any issues of this nature. And the last one is any corporate governance issues and intent issues from the promoter's end, right? So if the intents don't match, if there's no handshake on the potential terms, the deals will get dropped. And only the deals that make it through all of these screening areas will finally be invested in. So it's a very small opportunity set. So once you invest in a company, the focus of any is created, and value is not just making sure that there is financial engineering in place, and there is going to be a certain amount of return for the fund that has invested in it. That used to be the case 30 or 40 years ago. And I don't know whether you guys have seen uh, this movie called Barbarians at the Gate. So this is the genesis of KKR, which is one of the largest private equity funds in the world right now. But it started off with leveraged buyouts, and leveraged buyout was a huge opportunity, especially in developed world markets such as the US, where there's an opportunity to buy a company, take debt, and as long as your profits and margins start growing at a rate which is greater than the cost of debt, you essentially make money out of the deal. But those opportunities are now dwindling, and in the Indian context, it's more difficult for reasons I'll get into in the further slides. And therefore, operational optimization becomes quintessential for making sure that the deal performs well and the fund makes money. For operational optimization, I think there are many such levers. You reposition the business strategically. What do I mean by strategic repositioning? So there may be lines which are unprofitable, which might never get to profitability. So does it make sense to sell off those lines, right? That might be one. There might be asset heavy businesses. Would asset pivoting to an asset light model give better returns and help the company scale faster? That probably might be another such way. But these are just a few examples. But the core of the matter is that if you are a public company, it's much more difficult to take these calls than when you're a private company, and hence private equity ownership helps, where the management as well as the teams involved can experiment and leverage and make sure that they get things right before going public. In the public markets, you are tracked on month to month performance or quarter to quarter performance, and it becomes very difficult to reinvent a company when it's under the public eye. The second thing is operational optimization. So there might be everything from pricing to implementing Six Sigma lean methodologies and every other consulting framework in the book, depending on which company that we are dealing with, so that they get the right amount of optimization, make sure their margins expand in the process, and make sure that they can scale in a more effective manner. Digital transformation, I would say, would help a lot in this regard. I think in India today, you have an ecosystem of open networks from ONDC to UPI to other technology enablers, which is coming into force and which is being widely adopted. Leveraging those networks helps scale businesses in a more profitable manner, and that's going to be a game changer. Applying back-end software, let's say cloud analytics to predictive AI to migrating data in a central secure server would all help in making sure that the outcomes that we are looking for can be achieved. And the last but the most important thing is leadership and the governance part of it. Because without good governance, none of these measures would make any sense. The potential buyer for our funds or our firms rather would essentially look at whether the leadership team is capable of taking forward the company in the right direction for years to come, and whether the governance structures are in place where everything is squeaky clean and you don't have to worry about any corporate governance issues going forward once you make an investment in the company. So that becomes very essential to maintain. And as I was speaking about before, India as a market is a bit different from other markets. It's not like a US where you have depth of, let's say, the bond market, as well as you have a lower cost of capital, and leveraged buyout as a concept still exists. So today in India, you'll deal with a lot of promoter families, and each family has its own dynamic. So you have anywhere from family feuds to inheritance issues to also family dynamics that come into play when making any deal in family run businesses. So building trust with the key decision makers, treating it as a partnership and showing the full value of what a private equity investment can entail becomes very essential. India as a market is now also shifting from global capital to local capital. Global capital used to be rigid. So there were defined playbooks that was tried and tested out in a US, Europe, or a Southeast Asian market that could be imported into India, for lack of better word. But those strategies are now kind of saturating, mostly because the companies that would adopt these strategies are few and far in between. India is a marketscape where it is dominated by family-owned businesses. So local capital and an understanding of local mindset as well as a local way of working becomes very essential. And that's where domestic private equity funds have outperformed, and having those on-ground relationships really matter a lot. Are unmatched and unparalleled anywhere in the world, and utilizing them in the right way becomes an opportunity for any fund to make sure that they make the returns that they hope for. And there's a robust exit landscape that's today developing in the Indian context. So the IPO markets today have seen IPOs in the new age sectors, started off with Zomato and then with Paytm. There were a few hiccups and few failures also in some of the other IPOs that happened. But the market has learned quickly, and now you see Lenskart. Lenskart was is one of the portfolio companies of Premji Invest, IPO very successfully, and over a course of 10 years, we have seen a rapid value creation and tremendous returns for the fund in itself. So there have been success stories, Grow being another one, and uh, even Misho, for that matter, being another success story that has recently IPO'd. So that way, the depth of the market is now increasing, and investors are more comfortable to take a bet on the Indian stock markets, as well as the Indian investors who have deep enough pockets to buy companies often. And that, I think, is what will set apart the next couple of decades, where India will start moving towards the financial market depth similar to that of developed world markets. So moving on, I did cover how private equity works, but there are different kinds of, I mean, they're called venture capital, they're called growth equity and distress, but all of which essentially involves and entails investing, entails making money, and all of which are covered in my book as part of the private equity realm. So essentially, when venture capital involves taking bet on early stage companies, early stage businesses where the market is still not proven, or even the business for that matter is still not proven. You have a good thesis on the probability that such businesses or markets would succeed, and you take a bet on these businesses and in particular markets. Probably out of every 10 or 20 bets you take, it's 4 or 5 that will outperform everything else and make most of the returns for the fund. And that's been the story for some of these tech IPOs as well, for venture capital funds such as a Sequoia or a Elevation Capital or an Axel, where even though there have been failures in the portfolio, there have been huge successes, and even one large success is large enough to return the whole fund, and that's a pretty big outcome. So venture capital that way is very different from the other forms of private equity. The next is growth equity. So as the company evolves, so this chart and the slide is made from a perspective of how venture capital, how different forms of investing would take place at different stages in the life cycle of the company. So once the company evolves from being an early stage startup to more a stable business, growing business, which is growing at a very rapid rate, but the business model is established, the market is established. Now you are taking bet on its growth and its outcome that, okay, it's going to be the next big thing. That's where growth equity comes in. And the funds like General Atlantic or PMG Invest operate in this realm. You take minority positions, be actively involved in company management, make sure the company grows and grows in a profitable manner moving forward, which would enable your returns. Buyouts are for more mature companies. This is where the likes of a Blackstone or a Carlyle would come in. And this would typically involve some bit of debt, some bit of structuring, and making sure that you have enough funds and enough juice to squeeze out of the company once you are exiting the company. So here is where you buy companies at cheap and exit at a profit, to put it in very layman terms. But there's a lot of operational optimization, financial engineering, and strategic decision making involved in buyouts. The last stage is the distress or the special situation stage. This comes in when the companies are no longer operating in a stable manner. There have been certain disruptions in its business that has led to capacity. And that's where distress funding or special situations funding come in and help the company in crisis stage to turn around. And there are specific turnaround teams which help in operational optimization and management and make sure that the company turns around, revives, and goes back on the growth track again and making profits at a sustainable rate in a timely fashion. So, how do you judge whether you perform well or not in a private equity setup, right? And that's one of the most important questions there is because you make money on your performance, you make sure that the next fundraising is successful based on your earlier performance. And performance essentially points down to if you have invested 100 rupees, how much did you get back in return? So that's what's called multiple on invested capital. So if you got 300 back on 100, it's a 3x return or a 3x MOIC. And what's your internal rate of return? So at what percentage did that return compound? And I'm sure all of you would understand internal rates of return, so I'll not elaborate more on those points. So it elaborates on how efficiently the capital was deployed. And that's where even our profitability and carry does come in. So now I've covered more or less the broad process in which private equity operates from fundraising to investments to exits. Private equity is kind of a role where you don't have a set in which can take calls or make or break companies. A lot of it depends on judgment and psychology of investor. There might be certain companies where the numbers all seem right, the business model fits the bill completely well. But if there's a gut feel that okay, this might not make money for the fund and it might be a industry not worth investing in, investors do call it off. And as I was pointing out, making the wrong decisions of not investing is probably going to be as costly as making the wrong decisions of investing in a wrong company, right? And that's why most of these funds today have an anti-portfolio. Companies got away. Companies that did very well, but the firm chose not to invest in. So that's also a risk when it comes to competing in a very competitive landscape, for the same pool of investor capital, and making sure that you're above your peers when it comes to the returns that you make. So taking the right call is very essential, and it's just not about numbers. The second part is managing alignment and incentives. So India is a very mindset driven market, for lack of a better word, because there have been businesses that have been operating for 50, 100 years, family runs, where the promoters and founders come in with a specific set of values, ideals, and also thought processes which are very difficult to change. Bringing alignment, matching incentives, and making sure the incentives are in line with making money for the fund becomes very important. And that's where structuring the transaction in a way that benefits both founders, the management, the promoters, as well as the funds becomes very important. The last part is culture and making sure the transformation happens in the right way. Right? And now these businesses operate in a particular culture. So whenever you do an M&A, you think that, okay, you bought one company in your portfolio, you have a company in the other part of your portfolio, both of them make sense to marry each other. But culture might give way. So making sure that there is cultural alignment is very critical to success. And not just between companies, but also between the fund and the companies. There's a particular way of operating for every private equity fund. Making sure that we adjust our operational style to the companies that we invest in, especially people who are in constant touch with those managements, become very essential. And therefore, it is not just about a number game, as I put it here and even in my book. It's not about IRRs, it's not about the multiples or MOICs or the leverage ratios. It's an outcome that depends wholly and solely on people, even if the numbers stack up right. And with that, I'll end the presentation. Thank you so much for joining, and thanks a lot, everyone. Julie. And I'm
Yes.
opening the floor for questions and answers. Yes. Got it. If there's no questions, probably I'll end the talk with Sorry, Joey, if you have anything, please.
Yes. No, I was just gonna say, you can finish your thought.
Yeah, no, I was just about to end the conversation. What I was also planning to um, achieve with the talk and also further engagements with the I'm Indore community as well. So just to give a quick background to all, I've been part of the investment and private equity ecosystem for the past 10, 11 years now, worked across funds such as ISAF. It was an Edelweiss and CDPQ joint fund, one of the first in distress and special situations investing in India. And we raised $1.3 billion at that time, the largest domestic fundraise in India till that date. Then I was with Citibank's emerging markets PE fund called Citi Venture Capital International. We manage close to around $7 to $8 billion globally from Latin America, Argentina, Brazil, where to North America we had offices in New York and also operations in Canada, and emerging markets in Eastern Europe operated out of London to Africa. And I was managing the Asia bit for India and Asia, so Southeast Asia primarily, where we also acquired JP Morgan's private equity platform called Aero in a $750 million deal. Again, one of the larger deals during that time. I was also part of a board of a couple of Canadian pension fund subsidiaries, one called Rhodes with PSP Investments Canada, and one with public sector undertaking called Ircon International. My last role was with Premji Invest, where I used to look at consumer and consumer tech investors on the board as observer with Purple.com, one of the leading BPC marketplaces in India. And today, me along with a team is starting or trying to establish a $300 million fund, private equity fund. 300 million is already what we have as AUM, and we'll be launching a fund, third-party fund for 400 to $500 million. So that's broadly the context. And moving forward, would love to engage with all of you and try to help build the culture and interest in the domain for years to come. So with that, I'll probably end the talk, and thanks, Juhi, thanks, Gyan, for arranging this. It's been a delight coming here and explaining my book as well. Thank you so much.
Yes, so on behalf of the Alumni Committee, I would like to extend our heartfelt thanks to Mr. Nishant Prabhakar for taking the time to join us today and share his invaluable insights. Your perspectives on the private equity industry, grounded in real world investment experience and reflected in the capital in the shadows, have deepened our understanding of how value is created beyond spreadsheets and deal announcements. The insights you shared on governance, incentives, and operational discipline offer a nuanced view of how private equity backed organizations scale sustainably in complex environments. I would also like to thank Professor Manish Popri, Chair, Alumni Affairs, for his continued guidance and support. A special thanks to the Alumni Office, whose efforts behind the scenes made this talk possible. And of course, a big thank you to our wonderful audience for your active participation and engagement. We look forward to welcoming you again at our next session of Wisdom Pragya, the Alumni Talk Series. Thank you once again and have a wonderful day ahead.
Thank you. Thanks, everyone. See you. Bye.